We are live. Hi, Mike, and hi, Chris. Welcome to Venture with Grace.
Hey, Grace.
Hey,
Uh,
Grace, how's it going today?
it's been very. I woke up so early, so like right now, I feel like I'm just like very pumped with energy, but I also look super dead at the same time. But how about you guys?
Good. It's
Oh,
midday
well.
our time, so uh we're often started the day a little while ago.
Love that. Okay, so I want to start with a quick shout out to our amazing sponsor. This episode is brought to you by Vervent. If you're a GP or LP looking to simplify the capital raising and deployment process, Vervent is here to help. Trusted by over 800 funds and managing more than $2 billion in transaction, Vervent offers a secure, streamlined payment platform designed specifically for private capital markets. Say goodbye to manual reconciliation and repeat follow-ups. Raise and deploy capital faster and with greater transparency. Ready to make your fund operation smoother? Visit vervent.com or just visit our bit.ly link in the bottom of this show notes and then see how easy it can be. Okay, to start the show, I would love for the audience to get to know you guys a little bit more. So both of you guys were entrepreneurs. Even some of the like Chris is still running his entrepreneurship uh company now. But anyway, so why don't we start with what were the early lessons that in your career that kind of shape you into a better entrepreneur and investor? Also, Mike sold a company that's like $1.5 billion. That's which is quite impressive to Nestle. Yeah, I'll let you guys take the floor, and then we could talk about your entrepreneurial journey.
Chris, you want to start?
Sure. Yeah. So Grace, thanks for having us. Good to see you again. My career started more traditional. I'd say traditional kind of finance, banking to growth equity to venture capital. The back half of my career, I think, has been a little bit more unconventional and more exciting, and that's been the entrepreneurial, operational aspects of my career. I think that what I learned early on was to kind of just take chances and say yes to things. I think that what I've learned is just say yes, sort of trust but verify. It just puts you in situations that you're going to learn a ton no matter what. You never know where they're going to go, but try things, take leaps. Certainly, an entrepreneurial leap is a big one, but even little ones, just to take the coffee chat, take the meeting, stay late, all of those things early in the career, where I think what set me on kind of a different trajectory than maybe I would have been on had I not said yes to a lot of different things.
For sure.
Yeah, and I think similar to Chris, I started in the banking, but very quickly realized I hated working for people. So last time I've worked for someone was back in 2004, 2005. And that after I left banking, I really started the entrepreneurial process. I've done a little of everything. So I think very similar to Chris is, I think you've the hardest part of the entrepreneurial experience is taking that first jump and learning.
Mhm.
And certainly making mistakes along the way. But yeah, I think for me is I realized that I wanted to spend my time, energy, and effort in building things and building things that I thought should exist in the world. And I've been doing that for the last going on 20 years now. And it's rewarding. Certainly ups and downs, but I've been lucky that there's been more ups than downs.
For sure. I think okay, I was following your journey. So when at Freshly, you scale like the company to delivering 1 million meals per week across like 48 states. And currently, well, like I don't know if you're like still actively running Petfolk because it seems like on LinkedIn, it's like you're still actively running with your sister, and then you guys raised over 100 million. Why don't we start with like, I guess like how do you grow something to that scale? Like, I mean, at some point, I'm sure you probably have like gotten a lot of challenges. Like, I guess like what make you decided to keep going with those challenges, and then what kind of traction do you see early on when you are like selling um like the physical products? I guess like is there, because I think in the software there's always like traction of like, oh, we launched XYZ, and then on GitHub, like people are using it. There's like 5,000 GitHubs that are wake up, but I think it's very rare to see like traction with a physical product. I feel like it was a lot of people grinding. So I wonder if there's any early sign that make you feel like this is like worth pursuing, and what were your reaction when things got like very challenging? How do you decide to like stay or keep going? And
Yeah,
then
so
we'll
I
talk
think
about
so,
venture.
so with Freshly and I kind of with Petfolk, I think for me and I think there's many different ways to arrive at kind of starting a company, but for me it's always like scratching my own itch. So it's
Mhm.
something that I'm really passionate about. I think should exist and for some reason doesn't exist, at least not the way that I think it should exist. So I always come as kind of the first user, and I always think myself as like the first kind of power user. And I think sometimes that's easier to build for a product that you really like. Well, all businesses are different. All businesses really are the same in two things. You have to create a product that people love. You can measure that through many different ways, but the easiest one is upfront is NPS or some kind of survey. But really, it comes down to retention, reorder rates. How much do people interact with that product? So whether it's a digital product or a physical product, it's ultimately comes down to consumption. So if it's an app, it's daily active, monthly active, whatever that is, users, and if it's a product, it's reorder rates, potentially subscription rates. It's how much do people really like that product, and then referral rates is in there as well. So that's really that LTV portion that creates the value in LTV of that business, and then it's how efficient and how big is that TAM. So how many people are like in these cases like me? For me, it was easy. I didn't start with the idea that I wanted to start a company. I was trying to eat healthy, and I found it exceptionally hard to eat healthy. And I kind of just created a solution, and people started asking me to do it for them. And so the company kind of came second after me just trying to solve my own problem, which is I want to do healthy, but I didn't want to cook food. I'm not a big cook myself. And so we scaled because turns out there was millions and millions and millions of people out there who really wanted to eat healthy, but wanted it to taste good, be convenient. And so we kind of just kept evolving. And we started in 2015 when I met Chris. Chris was an early investor actually in Freshly. That's how we met. We were doing 300 meals a week, and we had traction. The people that were using it were loving it, but we needed capital to kind of grow basically our manufacturing capabilities so we could reach more people. And fast forward by the end of it was 2015 when we met. By the end of 2020, we were doing 550 million in sales. We were doing 1.1 million meals a week. And so there was just a lot of learning across that. The number one thing I always tell CEOs is you constantly got to be firing yourself from different roles within an organization and bringing on experts, and constantly be pushing to bring on great people who already have been down that journey to some degree. And we learned a lot. So the team that was with us, we're fortunate. A lot of team members that were with us just had the ability to kind of continue to flex up. And then Petfolk's been very much the same. As we had a vision that veterinary care could be delivered differently. And we've kind of done similar. We started with 0 locations in 23. And we've now scaled to 35 locations. Again, kind of similar thesis of I'm a huge pet owner. My sister, who's my co-founder and is a 30-year practicing vet. So we really were our first customers, both from the veterinary side and from the pet parent side. So we were able to build it the way we envisioned that it should work. And I think that kind of helped us move that business forward. Again, I always, it does come down to, at the end of the day, is like the customer has to love the product. I don't care if it's digital, if it's physical, if it's SaaS, if it's B2B, B2C, the end customer has to really love your product. And the more obsessed, the more they love it, the more likelihood you have tremendous amounts of success.
I wonder, maybe this is a question for the both of you. So I think one part about doing a consumer company, I think in my brief venture capital journey, I feel like when I started, I was looking at a lot of these consumer companies, but nowadays on my podcast, there's more of B2B SaaS founders, because I think there's very low predictability from the very early stage. And maybe we could talk about what would you focus on, since you Mike, you're an entrepreneur for many years, and then Chris, you have looked at these consumer companies you have invested in a lot of different consumer companies. So why don't we talk about, what were I think you mentioned about the customer have to love your product, but what were some early sign or the signs throughout the journey? And then at the beginning, do you focus on the product first, or do you focus on the unit economic? Because I know that you guys are backing some of the scrappy bootstrap founders, but I think the major problem of as a bootstrap founder myself, it's I'm growing very slow because not like I don't think I'm growing slow on the metric side from like our viewer or the company, like how frequently company is like pumping out product. But I think like by growing slow, it's like I could, if I'm like a venture back founder, I could hire people to like, sell more products, right? But I guess like um as a bootstrap founder, you have a lot of challenges because of like you have to do a bunch of stuff yourself because you don't have the budget to hire and grow really, really fast. But how do you guys think about like, essentially finding the bootstrap founder that can actually pull it off versus like the people who knows how to do 0 to 1 but don't know how to scale with venture capital money?
So a few questions in there to unpack. I'll start, and then Chris, you can certainly ask. So I'd say first and foremost, I think one of the things people as venture capitalists should see is that if you look at total U.S. GDP, let's say it's plus minus 26 trillion. Of that is you're basically looking at about 17 trillion in the consumer landscape, right? So the things we consume makes up a large majority. Software itself is only about a 1 trillion, between 700 billion and $1 trillion market. So the GDP percentage of GDP spend is massive in the consumer space. So then when you break upon consumer, obviously there's a lot of different things that go into consumer. So where I think when we put on our investor hat, I think we look for businesses that start off with better margins. Certain categories inside of consumer are just going to have better or worse margins, just purely by the area and the industry they're in. So, grocery is going to be a very low margin business, and certain aisles in the grocery store for products will be different margins within there, right? So you really can focus within there. We do like, and we do think about margin is a founder's friend, especially at the beginning. So the more margin you have, the more areas you have to invest in the product, the more areas you have to invest in marketing, team resources, those things. So which generally it's hard to scale quickly and scale without external capital on a thin margin business. So when you look at that, again, I think it is crucial of where you're starting, like what industry you choose. Ultimately, you can outrun the industry a little, but you can't completely change the economics of the category. And then from there, I think we do think if you choose the right category, and today now more so than ever, because the way you have 3PLs, co-mans, AI coming on really strong to support early founders. We do think founders can build amazing companies bootstrapping or with very, very little capital. The ability to be efficient in the consumer space exists like it never has. Even if you go back to 2015 when I started Freshly, it is night and day. We're talking 10 years apart. It's not that long of time. Like you could not have built a business, like you would never build a business like we built Freshly. Not because we were dumb and didn't make the right decision at this time. It's just because the world has drastically changed since then. So I think we're extraordinarily excited about founders' ability today to build very, very efficient businesses and build those companies and scale them relatively quickly. Now, I do think consumer businesses often, and I wouldn't say is the absolute rule, but let's say is the 90% rule, are never have the ability to scale as quickly as a software product. Software is scaling bits. Bits can scale exponentially really easily. Scaling atoms, it likes to scale a little more linearly. You have supply chains, you have inventory, you have a lot of things that need. So we do think they kind of scale a little differently. And you have to, I think investors need to make sure that you're not kind of copying and pasting one investing model onto one category. So you can't just say, oh, we're VCs. So thus it's all binary power laws. Every business is going to be $1 billion business. I think that's where people make a lot of mistakes when they invest in consumer is they take this kind of technology mindset. And some founders will also make that mistake as they think that they're a tech company versus no, you're a consumer company. And I think that sometimes can be a mistake. I don't know, Chris, what did I leave out on that?
Yeah, no, the only thing I'd add, because Grace mentioned kind of product and unit economics, which are very important, but even ahead of that, we look at team and market. So that's kind of our stack ranking is the people, then the market, then the product, and then really the numbers and the deal and the economics. Reason for that is, and this is kind of what I learned at Highland, is when you're backing early stage companies, the people never change. So you're really backing the people. And you want to back people in really interesting, large, and dynamic growing markets. The product is going to evolve. It's going to change. And unit economics, generally are fairly early, and those are going to evolve as well. So that's kind of the stack ranking we like to look at when we look at deals. That last one, though, the data and the unit economics, they are really important. They're not going to be perfect at the stage that we're investing, which we know. We've been there. We've been the operators. But we know what to look for those signals that say, hey, something's breaking out here. This is better than most. And it's also why we tend to back companies that have a little bit of traction. So we have some data to dig into. That kind of comes from my banking growth equity days. Is we do like data. We don't typically fund ideas and business plans. But having been founders, operators, we know that in the early days, everything isn't perfect. There's a lot to be figured out. And that's kind of what we like. And that's the challenge that we get excited by.
I have a huge question for you guys. I really like what you said about focusing on the team and then the market, and then there's the efficiency side of things. But I wonder, in the consumer space, one of the biggest thing is by the way, shout out to Strive. Okay, so I just want to give the audience, whoever comments, to a quick shout out. But anyway, so for the competition side, I think for any consumer product, you can find 5 things that are in the same category within a month. So how do you guys think about competition in general? If a person just straight up copy Petfolk, or Beam, what would you guys suggest a founder to do, or what would you guys do as founders?
Yeah, I mean, my opinion's always been is that building great companies is an internal thing only, and it's internal with your customer. So it's building a relationship and delivering on the promise and commitment with your customer. Don't get distracted too much on what people are doing. If it's a tremendous copying is a tremendous flattery. It's you just got to continuously evolve and meet the needs of your customers, and I think you'll build a great business. I mean, certainly be aware, but at the end of the day, great businesses are built because the people continue to remain internally focused on improving the product, improving the experience, being laser focused on their customers. And I think you ultimately win that way in the long term. You can get overly distracted and there can be heel biters and stuff, but I think we built such a big business at Freshly, not because there weren't competitors. There was exact to the pixel copies of our website, literally with a name change, but everything was the same. At the end of the day, what we knew is we were going to do a better job than them. We knew we were going to deliver on our promise and commitment. We were going to do all the hard things right. And so it was sometimes annoying, but at the end of the day, we just kept chugging forward.
I think I was just going to add, I think what I'd say is good luck, because it's not easy. I think consumer businesses, you don't necessarily have the IP or defensibility of certain things. It's all execution. So it's can you out execute the competition? It's small, tiny wins across the entire business. So Mike mentioned gross margin being super important. Those are basis point wins that take time. Marketing, customer acquisition, retention, those are all things that there's no silver bullets, unfortunately. So it's a grind. It's why when we talk about team, we tend to back kind of the gritty founders that have bootstrapped their way to some success, because that's really hard, and that's a good proof point for us. So the markets we're in, they're big enough to support many similar companies. We just want to pick the right people that are going to out execute.
How do you out execute someone? I think a lot of people are really hardworking, and I think the competition, I don't fear of people copying my exact website, and people would come up to me at different conference or something and say, oh, I'm actually gonna be the different geographic version of you, and I was okay, I'm so flattered. But I think I don't fear people copying our entire website or whatever I'm doing, but I fear of the people who are doing the exactly opposite of the approach, or maybe some second approach that's on your roadmap, but in a different strategy domain, right? So if someone's doing something very different but serving the same audience, and how do you think about I guess when people are doing something different from you, but also it's in the long term they may eat up the business? How do you think about just people taking a different approach but trying to but enter to take part of your market share? And I suppose investor and founder.
Yeah, I think from our standpoint, as kind of as Chris said, we first and foremost focus on TAMs that are large. I do think if you are focusing on a very narrow TAM, you really have to make sure that you own that and you're moving quickly. We also try to, we as I said, you can't scale the exact same way that like an exponential scale. We try to scale very linearly quickly so we can build market awareness, market brand reach, consistency. But where I've seen people make the biggest mistake actually is starting thinking about the macro versus the micro. And at the beginning, like you need to win with like a handful of customers. Then that handful needs to be hundreds, and then it's thousands, and then it's so being overly concerned with peripheral markets or like markets that are on the side or potential like that things you maybe at some stage could get into versus owning the thing you're doing. And as Chris said, it is a bunch of micro wins that happen over time. So it's thinking through, again, it's all the things that you really have to think through is, not only how do you acquire that customer, but how do you know exactly who the customer is that you want to acquire, or who's the most valuable customer? How do you make sure your brand is authentic and speaks to that customer and lives that in every single moment? How do you make sure that you have, efficient marketing, efficient customer communications, retention, depending what the product is, and then do that every time at scale and repeat that. So I think the best way to win is to win with a narrow market at the beginning, be laser focused on that narrow market, continue to expand and scale aggressively in that narrow market, and not actually try to spread out too quickly. I think that's generally where I see founders make the biggest mistake, is when they start trying to be the everything right from the get-go, because then it's very unclear of like, what are you best in class at? You take most consumer brands, like really big legacy consumer brands that are massive, and people forget that Coca-Cola was a single product for, 40, 50 years. It was one product. And yes, now when you look at Coca-Cola, the brand, the enterprise, it's massive. But, if you look at Nike was running shoes. It was only running shoes for a very, very, very long time. So I think when you look at consumer products, they stand for one thing and they earn the right to get in the next thing. And so that's what I would almost always advise founders is like, don't try to be Nike today. Like, be Nike when they started. Be Nike when they started and they were just a running, and the cult was running, and everything in Nike was all about running. And it was that for 20 years, right? Before they started expanding into other categories. I think people forget kind of the time of how these brands evolved.
Wow, I love that. So like basically focus on like one single thing, or like doing the micro thing that will help you win that day, instead of like being very overly obsessive about like chasing something really gigantic, or like I guess doing every day, right? Instead of doing
I think if you create obsessive fans of your product, whatever it is, and when they think in category, you are the absolute number of that thing, that earns you the right to do the next thing right next to it, right? But if you try to be everything to everyone, then what you end up becoming is confusing, and you kind of leave that early fan too early. So, it always depends on the market size, all these different things. But when in doubt, err towards being more focused than less focused is what I'd say.
How do you guys think about the distribution? So like, I'm going to give you guys some examples, since I know that you guys are living in the consumer world, but I think in the B2B SaaS world, people are picking up the consumer marketing strategies. Like, people were like spending like, $150K on making a SaaS video hot. Like, how do you guys think about distribution? Since I feel like we're in like an influencer society, every consumer company is basically dumping dollars into the TikTokers or YouTubers who are going to help them marketing their product. And all the big influencers, like in the creator space myself, I feel like watching a lot of these big influencers building their own brand. How do you guys think about the distribution side of things? Like, how do you distribute a consumer product effectively and like efficiently, not like as crazy expensive by paying Mr. Beast doing an ad? No offense to Mr. Beast. I think he's too great. So
I'll touch on a couple things. And so it may be helpful too, just to give a quick kind of overview on our fund and what we focus on in our strategy. So Cutting Horse is a new fund we've launched to back early stage consumer entrepreneurs. We back both product entrepreneurs and also service entrepreneurs. The marketing and distribution strategies for each, some of it's similar, some of it's different. So on the product side, on both sides, I think you want a diversified mix of channels. Again, back to no silver bullets. There's no silver bullets on the marketing side. There's not going to be one thing, one trick that, it may give you a pop, but then it dies. And so you always need to be constantly learning and trying new different channels. On the product side, certainly it's more of the performance-driven marketing that we see. So your Metas, your Googles, your influencer, TikToks. On the service side, these tend to be more local, geographic-focused businesses like Petfolk. It's a little bit of a different playbook there. It's your kind of guerrilla local marketing, getting the word out in the community. Again, both sides, there's no single channel that's going to get you there, but it's constantly testing, constantly iterating. We're big data junkies, so follow the data, track everything, so know what channels are working, not just on the CAC acquisition side, but on the retention side. What kind of customers are you getting? So these are the things we talk about with all the companies we invest in, because obviously acquisition and growth are huge, but it's a constant iteration.
Yeah, and I'd say I'd just add to that as well. I think where I see founders do it really well, and where I see founders, in my opinion, not do it as well, is I think founders who are out there trying to find like the intellectual honesty, they're not trying to prove whether they're right. I think the challenge is with any one thing is you really need to understand, like, how is that, what is that customer acquisition cost on any one channel? How are we measuring that customer acquisition? Some you can measure very cleanly, some you can't. Some, like TV and things like that, you have to really kind of think through. So the founders that we see do the best is they're laser focused on owning one channel. So they're very good at owning one channel. They start off really, whether that's Meta, usually Meta's for consumer products going to be your earliest, TikTok a little bit, and then influencers as well, but then really building a strategy that's cohesive and works. So I think where we see founders get in trouble is they're like, oh, we've heard about influencers, we're going to hire Mr. Beast. And that's kind of more ego, like, because you don't, like, the founders who do it really well tend to be a little more micro. They know exactly who the micro influencers are in their category, how those move the needle. Again, Mr. Beast has a massive audience. It's huge, but it's also a very broad audience. So that tends to be, you already need to have a tremendous amount of distribution. You already need to be, so those tend to not be as efficient as the Kardashians. They tend not to be that efficient for smaller brands. They tend to be more efficient for really large brands. And I think also it's great that influencers are starting to realize that they can create their own products, their own brands. Now, what I would say is most influencers, even if you look at a Mr. Beast or a Rock, like, once you activate your audience, you still, in order to get past a certain size, you have to get really good at activating different audiences. And so I think it's great. I think it's a tremendous opportunity. I do think that's going to continue, where now it's easier and easier to launch consumer brands. And I think, what you're seeing is influencers who are saying, what are the different revenue streams we can create? And if we can create our own products and those really authentically match who we are as an individual, those can be, it could be very symbiotic between marketing and how do you build that brand. I don't think it's right for everyone. I think you still need really good operators, and certainly some influencers are that. Some influencers can partner, but I do think in the consumer space, it does cut down, as Chris said, is you really have to be a very good operator. It's a lot of little things that have to get done right.
I have a question about this. So, like, one thing is, since, for example, Petfolk or Freshly, like, I think, like, when you first grow the company, how do you identify who is your core user? Because, like, even people living in New York or Silicon Valley, like, people have different preference, right? Like, where do you find them? And obviously, you were selling to yourself at the beginning, but I guess, like, how do you identify who would be the person who's, like, going to pay this amount of money into this? And then also, like, for Petfolk, since you guys have, like, multiple store, you mentioned 20 something store, like, how do you know which geographical location that you should target first? And how do you make sure that all the services are very aligned with each different store? Like, how do you manage these stores to have consistency? too?
It starts with a vision. So you got to kind of think. It starts with at least like we think this is our customer. You have to before there's any, and then after that, everything's data. And so with Freshly, it was very much we had customers who come on. We'd be able to see on Meta on platform what demographics, what different people were actually interacting with ads. So first and foremost, does someone find your product interesting even before they buy it? Are they interacting with the ad? Are they actually showing up and interacting? Because before you buy a product, you actually have to visit the website if it's an online product. So really, and then after that, then what you're really looking at is how much it costs to acquire a certain kind of customer. And then equally, if not more important, is that customer's usage behavior. So some customers may buy your product. Your product may not actually fulfill the need they want, or they may not like certain aspects of that product. So I think sometimes you can change the product to meet that customer's need. I think in the early days, more often is the right approach is to find who's the customer who loves your product, who's using your product a lot, and then go find more customers like that. So what you really want to do is define down, and then that is often supported by like how you go to market, right? So if you go to market as a super premium product, right, then you're likely going to need a high household income. So you can already kind of narrow down. There's certain categories that are going to be more predominantly men or women. So you can kind of already theorize, like, if I'm going super high end cosmetics, I can already kind of predefine my category a little. You sometimes get some surprises on that, but most of the time you can kind of stand there. From a real estate standpoint, it's that on steroids. So we have tremendous amount of data systems that we're looking to say, who are our right customers? Where are they? Then we overlay traffic patterns, halo brand, different brands that have co-tenancy that's really important. And then we're constantly retesting. So we do a refresh on our models on that business every quarter, where we're constantly reevaluating and refreshing, because with data, sometimes you can get confirmation bias. So if I'm a cosmetic company and I don't know, maybe cosmetics is more extreme, but let's say I'm a food company and I think, okay, we're selling a protein and we think predominantly our customer is going to be male. And so we market towards males. And so thus our customer is male because we're marketing to male. And then, so you always want to test around the edges. And Chris said this is, you kind of always want to test that. We think this is right, but we always want to test to see, hey, maybe actually is there a broadening in the market and we got that wrong. So I think, and as companies evolve, as you bring new products, as you potentially maybe do rebranding, as you do different things, your customers could evolve and change. So you constantly want to be challenging your assumptions. But at the end of the day, I always tell people is do what's easy first, right? So what's easy is don't change the product, find the customer who already loves the product and market more to that. Kind of goes back to that, stay focused. So like certain people love your product they're using, make sure you're really activating that market before you try to go to the next one. Because too often people try to immediately go to the next one versus being like, hey, and in consumer, again, $16 trillion market. You can own a very, very, very small subsection, tiny little section, and you can build a $200, $300 million revenue business, right? So you can build really, really big businesses in the consumer landscape being very narrow. So try to make sure you're owning your space first before you go to the next one.
Wow, I love that. Okay, so let's talk about Cutting Horse. So what does the name mean? And I know that you guys are focusing on like early stage consumer market. So like, how do you quickly identify what are something that's like doesn't fit your investment thesis? Because I think like from this podcast or like from like every day, like I'm sure like everyone will try to, by the way, everyone's coming from YouTube today. Hi, Himas. So sorry, normally it's like, Twitter, LinkedIn or something, but like today it's like, YouTube. But okay, so how do you guys think about like, I guess like what are something not to invest in? Because you mentioned about like, focus on the profit margin, and then like also like just quickly identify something that's just like will never work, because I think everyone will try to pitch you guys about their anything that's like in the consumer space, right? Like everybody's like developing, I don't know, protein powder, but how do you quickly filter out like what is like worth looking at?
All right, well, I can take a start, and Mike, feel free to jump in. So on the name, so Mike grew up on a ranch in southern Arizona, and we quickly got onto the Western theme when we were thinking of names for the company. I actually came across Cutting Horse in doing some research, and there were some kind of cool analogies we liked there. So a cutting horse is traditionally a working ranch horse that can go into a herd of cattle and separate or extract one cow from the herd. We liked that analogy because as we're looking to this question, we're looking at thousands of businesses, and it's up to us to find and extract those unique entrepreneurs and businesses from the herd. So we thought it was a cool analogy there. The cutting horses have both a athletic and physical abilities, but also an intellect and to be able to go and do that job. So that's how we came up with the name. Switching over to kind of like what is a cutting horse deal, which is kind of how we refer to it. There's a lot of different things we look at, but we try to start with some quantitative metrics that just help us very quickly filter opportunities and say, hey, maybe interesting, but it's not a cutting horse deal. So for us, we call them the cutting horse big five as we see companies. What that starts with is 1 to 15 million in revenue, 50% growth, 50% gross margin, profitable or better, break even or better, and then capital efficient. So that for us means either bootstrapped or lightly capitalized. We don't need to go 5 for 5 on those, but that gives us a quick read on a company to say, hey, does this feel like the scrappy, bootstrapped, cutting horse style deal or not? Is it, maybe it's a nice business, but it's a, more mom and pop sleepy business. Maybe it's a really exciting kind of venture-y business, but it's burning tons of capital and it's not a fit for us. So we start with that quantitative screen. We really need to go, 3 for 5 or more on those. And then we roll into more of the qualitative of, is this in one of the thesis areas where we're currently hunting? We talked about people. Do we really like the founder and the entrepreneur behind the business? We go through, significant diligence from thereafter, but we start with that top of funnel screen because we are seeing hundreds of opportunities and we have a lean team. So we want to quickly get to those ones that feel like a cutting horse deal.
For sure.
And just to add to that, what I'd say as well is like our job is to see lots of decks. So if you have a deck, if you're pitching a company, please feel free to send it. We do try to be quick with a response. Again, I'm as a founder myself, I always know when I'm fundraising is second to yes is a quick no, right? So if someone's not going to do a deal, you don't want them spinning. So we try to be very respectful of founders' time with a quick answer. And then we try to be helpful within our network. If we're not a right fit, do we think someone else is? Doesn't mean we can always point someone. Chris didn't hit this, but we're also U.S. only, so we generally are U.S. But again, we're always happy. We'll try to be as responsive as quick as we can, depending on what's going on. But if it is someone in a different country and we have some connections, we try to help and say, hey, we're not the right person, but maybe talk to this person. And give quick feedback on the business. But as Chris said, we're pretty narrow. We'll do anywhere from 4 to 5 deals a year, so we're also fairly selective and depending on how many deals we're doing or in process of doing, that kind of changes our cadence as well. But again, we try to be and speak to and be as helpful as we can to founders. Even I think a lot of founders will say, even if we're not a right partner, and we'll select, sometimes a founder will select and say, I don't think you guys are right for kind of my vision of growing, and that's fine. But we always want to be helpful. We always want to be helpful in saying, hey, if we're not the right partner, is there someone in our network? And we do have a very broad networking consumer that we can point people to.
I wonder, quickly shout out to Charles. Hi, Charles. So he likes the name of cutting course. Okay, so why don't we talk about, since like Chris mentioned a fuel benchmark, right? Like 1 to 15 million in revenue and then 50% growth and 50% growth margin. Like if I were at that stage, I'd be keep bootstrapping. That seems like I'm doing something right. Why would I pick an investor?
I think so. The biggest thing for us is you really want a partner to help you through that next stage and that next journey. Also, it could be that you're really kind of tight on capital and now you're getting inventory concerns and stuff. So you need to put more money on balance sheet. I think the biggest thing we bring is not capital, it's our experience and our experience to help founders that are in that journey who say, I really want to build a 200-300 $100 million business, and I really need some help getting to that stage. I've done a great job, but again, an advisor or a coach, we're much more hands-on. We do a very concentrated amount of investments, so we really do come on, especially at the beginning, almost as like a co-founder. We're very hands-on, so I think we're different to that biggest thing that people take our capital is we're operators, so we can come in very quickly versus I think a lot of your traditional VCs have been VCs for their whole life. They've done is VCs, and even if they say we're going to be really helpful or we have this team, they've actually never. I've scaled now 2 businesses, freshly went from 3 employees to 2,500 in 5 years. So we understand the challenges of scale. We understand the challenges of supply chain, marketing, all those things. So we can come in and just add a lot more kind of tactical real life support to help build the businesses. And I think that's where we are very differentiated in that. And we want to be partners to take someone to that next stage of that journey. Chris, what did I miss on that?
Yeah, it's a good question, because oftentimes the companies that we talk to are not fundraising. We do a lot of thesis-driven outbound. There's no deck. There's no financial model ready to go. It's us talking to the founder and really seeing if there's alignment on the vision for the company and where we think we can help them take it. And each company is going to be a little bit different in terms of where they think we can lean in and add value. But we've just done this so many times. We kind of have the playbook. We can help them see around corners. And oftentimes it's the kind of the certainty of an eventual exit. They feel that bringing us on helps de-risk that exit or make that exit, greater than it would be if they did it on their own. And like Mike said, it's usually not the capital that's really, the deal maker here. It's our ability to add value to the businesses and the entrepreneurs.
I wonder, since like at the beginning you guys talk about the check size, but I guess like how does your portfolio construction look like? I'm sure since you're investing in 4 or 5 deals per year, that means like between like 12 to 15 deals per fund. And how much of like the ownership are you targeting, and that will be like worthwhile for your fund?
Yeah, so it is a concentrated portfolio. It's more akin to a growth equity portfolio than a seed portfolio. With that comes more concentrated ownership in the companies. We would rather do fewer businesses, but spend more time with them. And so that usually means we target 25, sometimes up to 30% ownership in these companies. So it's meaningful stake, but it means we can add meaningful time and value to the entrepreneur. But that's kind of how we think about portfolio construction. These are businesses that are, as we mentioned, they often are profitable, growing. We look for a 5 to 10x multiple on capital with a sort of a 1x downside. So it's not the power law dynamics of a typical seed or venture portfolio. We want all of the businesses to be winners. And so that's why we do fewer, we own more, and we really work work alongside the entrepreneurs to help them.
For sure. By the way, hi Yash. I see people making friends in the comments section. I wonder since Mike, you have sold a company to Nestlé for $1.5 billion, and then Chris, you have like helped Mike as an investor. So like throughout the journey, I guess when you're thinking backwards, right? A lot of like entrepreneur's dream is to sell a company to somewhere for $1 billion. And how do you guys think about like things that you have done right versus things that you could have like done better? And what would be your advice for founders who, even people that you may consider backing? So I think a lot of people's ambition is not technically like, I just want to IPO, because I think in the consumer space, there's not many company that's, well, correct me if I'm wrong, but like from what I'm observing, I think most of the company that IPO are like tech driven or something. Like it's consumer company are generally being bought by a different company, like from, Poppy or these like really cool brands, like everybody just like, getting bought by someone. How do you think about the exit strategy for consumer company?
Yeah, I think so. You hit on one thing that's really important that we always try to start our conversation with the founders, is starting with, what does success look like? Because I think people don't spend enough time. You kind of get in and you say like, oh, okay, but what does success really look like? Is success, because for some people, success is, I want a $20 billion business. For some people, it's, hey, I would like to make $20-30 million in the next 5 years. And so what we really want to align on is what does that success look like? Because how you get there, how soon you get there, there's different risks you have to take, right? And depending on the business and they say, so we start with the end in mind. You said it is perfectly. We also think that, like, I think so much of people in the startup world, they spend a lot of time on blogs that used to back in the day be TechCrunch, whatever it is, and they hear about the big flashy, whether it's Poppy, whether it's these things, these big CPG exits, right? And so you think like, okay, that's where but a large majority, most acquisitions, 85-90% of acquisitions happen sub 200 million. So there are a ton of acquisitions that happen there. And then, yes, I totally agree on both tech and any business. IPOs is very rare. It's the rarest of all. M&A is going to be your highest likelihood to get out of the business. But where people don't understand, especially in the consumer space, but also in tech as well, is that there's this huge middle market private equity buyer, and that can mean many different things. We always try to talk with our founders is like, selling a piece or selling even a majority of the company does not necessarily mean you leave, does not necessarily mean your journey as a both shareholder, as a CEO ends. And you can be on this journey for 30, 40 years with different owners, and you can continue to make, and you can take little pieces off at every point, right? And that's what we always talk about is people sometimes think about selling as binary, right? So it's like, oh, okay, an exit. Now, we try to talk to it is like, you can sell the whole company, you can sell a small piece, you can get liquidity. The first million is the most important million you make, right? By far, in magnitudes, exponential. The first 10 million you make drastically changes your life for the rest of your entire life. After that, it's a lot less. So we always talk to people is success should be kind of staged, and it should get you to these different hurdles, and these different hurdles unlock safety, security, flexibility for you and your family. And so you should be thinking about these things. Don't think about things as binary success is like, okay, I built this business, either goes to 0 or $1 billion. I think that's the challenge that a lot of these VCs have been pushing, this idea of these, power law dynamics. One of our business, all we care about is one of our companies. It's going to be a 10 billion, decacorn. And so everything is built, every business to be a decacorn. And if it flames out, who cares? We're going to have one or two of these portfolio companies. I think that doesn't need to be the case in consumer. I think you can have amazing exits at 50, 60. What may not be a headline, story written in the front page of the Wall Street Journal, but it can be tremendous amount of success for you, your family, the team members, and all these things. So we try to think through of starting with the end in mind and not being dead set that everything has to be like, everyone has to be the next Zuckerberg or the next Elon Musk. It's like there's a lot of success that happens at smaller areas that will drastically change people's lives.
For sure. Chris, you want to add something?
Yeah, I would just kind of echo that in many ways, we act as a bridge from the earlier bootstrap stage to the more institutional capital that sits above us, be it traditional growth equity, private equity. Those buyers, in our view, are always going to be there. So why not build businesses that are attractive for them and that are sustainable and don't necessarily have to exit at any given time? That's what we think is build a strong business that's profitable, growing, and of some meaningful scale. And there will be plenty of buyers there. And so that's what we aim to do with all of our companies. And we're in constant dialogue with those upstream buyers in terms of what are they looking for, what categories are interesting for them. But that helps with the certainty that Mike mentioned. That's kind of like the certainty of getting that initial liquidity is not having that binary outcome of we need to be $1 billion or bust. We've done that. We've been the beneficiary in many ways, but we just see a more interesting risk return profile at the stage that we're playing with the fund.
I wonder, so one question about like working with you guys is like, okay, so since you're shooting for like a significant amount of equity, and obviously it comes with the investment, but like, I guess, how do you guys work with the entrepreneurs that in your portfolio? Since let's say every year you invest in 4 or 5 companies, like, do you spend each quarter with one company or like how does it kind of work when, let's say, like I'm adding myself into a cutting course portfolio? Do I just chat with other cutting course founder all day, every day, or should I chat with both of you guys every quarter? How frequently do you engage with the founder and how closely do you help them monitor these like data and everything else?
Very frequently, I'd say. I mean, different rates. So almost everyone on our team plays kind of different roles. So we're often not on every single call together. In fact, we're rarely, unless it's a board meeting or kind of formal. Say probably on average, you'd say 6 formal kind of board meetings. We say strategy. We're very much in the weeds on data weekly. We get weekly reports with our founders. We want to stay up to tune so we could be helpful. If we're not getting real time data, then it's tough for us to be strategical. And then different team members will have different interlays with different team members to the level of, we have more junior people on our team speaking every week, probably twice a week, with team members, kind of helping them build, making sure we're building the right models and structure for that. And then Chris and I kind of different cadences as needed. But I would say on average, probably one of us is talking to someone. Well, for sure, our junior people are talking once a week, and then Chris and I are probably on average speaking once, if not twice a week, collectively as well. So it's what we do. I think the fun thing for us is, we love doing it. So it's like we're always on. So I always say I'm like 7-Eleven. I may not always be doing business, but I'm always open for business. So if it's Saturday, if it's Sunday, if you got a question, if I could be helpful, I just like, it's what we love doing. We invest in founders that we really enjoy, and we invest in companies that we believe in. So when a founder says, "Hey, I have a question, I want to talk about something," we're there. And I think because Chris and I have a tremendous amount of operational experience and a really big network, not only like with investors, we have a massive network of marketers, of all these things. So 9 out of 10 times we can just say like, "Oh yeah, we've dealt with this. This is the person you should talk to." So a lot of the times for us, it's connecting the dots between two things, or here's what we've done in the past, and we don't always have like a definitive correct answer. But we can give a thought, and we could be a good thought partner with that person pretty quickly. But it's why we're only crunching. We only do 12 portfolios because we know that after that we're going to kind of crunch down, and we don't have enough bandwidth on that. Tends to be a lot more focused in the early stage, so we're spending a lot of time in the first year. A little less after that, and then a lot towards the exit as well.
I wonder, so how do you guys think about the exit for your fund? Since like I think the venture model, why people invest in first fund typically are because of like the first fund are going to have like very crazy returns. So like, for example, I think if you're doing, I don't know, like a $10 million fund, you just have to, let's say you invest in 40 companies, you just have to have a certain amount of ownership in one of the, I guess, $1 billion company, and then you're good. Or like, I think I did the math. If you're a 40 company, you have to one company hit like 5 billion, and then two companies hit 1 billion. But I guess like, how do you guys think about the return from the stage that you're investing in? And then also the capital is a lot more, the ownership is a lot higher, but like what kind of exit does the 12 company have to hit? It's like 200 million for each company, or like, I'm sure some company may unfortunately die, but like what's the success rate at the at the stage that you invest in these companies? And what if it doesn't exit? Like it just keeps dropping and then it doesn't die either. Like how do you kind of like exit if they don't exit?
Yeah, on overall kind of exit ranges, I mean, typically we look at that $100 to $300 million range as kind of a sweet spot for us. Certainly, we have businesses where they could sell for less than 100 million and still deliver an exceptional return. And on the flip side, there's going to be companies that are really breaking out. We've had the benefit of seeing companies get to $1 billion or north of $1 billion, so we know what that looks like and feels like. It's not it's not our base case to sell to Nestlé for $1 billion or a strategic, but those do exist, and those would be the kind of multiple fund returners if we get there, but they're not our base case underwriting scenario. So we want to get to our 5x base case at those fairly modest and reasonable exit ranges where we know there's a number of buyers, private equity, growth equity, strategic, all converging on this $100, $200, $300 million range. And then like you said, the seed funds, one company will return, 90% of the returns. For us, we see it much more distributed. So we look for all of our, 10, 12 companies to be, to return, make a nice return for us. Again, one or two could break out, but they're not going to be the vast majority of the return. So it's a risk adjusted way to get what we think we can still get 5 to 10x fund returns, but do it again in a more risk adjusted kind of growth equity.
Yeah, way. And I think so. Our focus is what I would also say is a little more. First of all, at GPs, we're really oversized, committed in the fund, so we're really running our own capital in this. And so what we look at it is IRR. So I think the industry looks at things a lot of times. I don't agree with all the things. So MOIC is relevant based on time. So I could give you a 20x return fund over 30 years, and it's not going to be that great of an IRR fund, right? So we look at DPI, and we really think about cash on cash returns and IRR. So I think we ultimately think we can deliver a top quartile, even MOIC fund as we look at 5 to 10x, but where we really are going to aim for is top quartile in IRR and DPI. Our window where we look for exit starts at 3 and goes to 7. So it's really more of a PE structure in that. What we do exceptionally well is we are really good, as Chris said, of meeting companies at 1 million and taking them to, let's just say, 100 million. That's kind of our perfect range that we like. And we're okay handing the baton. I think traditional seed, which is where we're very far, is traditionally going to be a little more spray and pay. You're gonna spread out a lot of money. You're gonna close your eyes and hopefully in 13 years wake up and one of those. But it's a long fund duration, and it's basically betting on the market, and then you're very victims to IPO markets and things like that. So again, ours is really much more built towards EBITDA buyers. So when we look at businesses, we're really thinking about who are those EBITDA buyers, what are realistic EBITDA multiples look like. That usually means you're in the 10 to high end on 16 times EBITDA multiples. We base our underwriting so that we can return those level of success based upon real cash on cash kind of EBITDA multiples. So I think, a lot of times people will say, well, what's the exit multiple on revenue? It's like, well, most exit multiples are not actually done on revenue. They're done on EBITDA, maybe some degree of an adjusted EBITDA, but they're done on EBITDA. That's the meat of where the buyers are. I think so often in consumer, people do focus only on strategic. They do focus only on, but the majority of trades that are happening are middle market buyers, are those. And now, obviously, a business is a lot easier for strategic to buy because most strategics in the CPG world are measured on EBITDA. A lot easier for them to buy if they have an EBITDA multiple they can attach to that. So again, I think our structure of our fund is we fit in this kind of no man land. We deliver VC style returns, but we really underrate, similar to a private equity or late stage growth equity. We're just doing it earlier and more concentrated. So again, we think our style is really built. You're hiring us as managers. You're bringing us and co-investing really with us on a narrow stage of someone's life. And we always tell them that's our founders the same thing. It's like, we're not going to likely be here beyond that, but that doesn't mean you can't. In fact, it's likely going to be beneficial for you at all stages to be with this company as long as you're excited and you're energized by doing this company. And any investor or person who's going to come in and buy a piece of that company, because at the end, when you invest, that's all you're doing is you're buying a piece of the company, right? And so I think people think about M&A as like majority versus minority. It's like you're buying a piece of that company. They're going to want to see great management, great leadership, people that are excited to build that product and continue to thrive. And you could be on that journey for 30, 40, 50 years if you want to. We likely won't, but that's okay. We're going to hand it off to someone that's going to take you on that next stage of that journey. And I think that's traditionally how consumer has been done best and invested in best is some degree of experts at different levels who bring a different kind of different value set.
I want to close out with like maybe one real question and then 30-second fire round. Do you guys still have the time?
Yeah.
Sure.
Okay, perfect. One real question is like, since you guys talked about these exit, like what are the mindset of these companies? So for Nestlé to acquire Freshly, like I guess like what kind of market are they tapping into, or like are they because of like it's like a really good cash flow business, like, and that could be add on to their existing services? Like it doesn't have to be using your own company, but as an example, but like we could talk about like maybe any of your portfolio company or like company that you've seen. Like, what's the mindset from the buyer? Like, who are the usual buyers?
So let's go through a few different categories of buyers, because I
Right.
think strategics is one, but let's start with large family offices.
Mm-hmm.
Large family offices want to deploy a large amount of capital. They like buying cash flow businesses because those cash flow businesses deliver real value, and they really like having strong managers in place that they can grow. They can also be kind of evergreen investors. They can hold assets for really long times. They're fine. They're looking for more cash dividend returns or the ability to reinvest that cash flow back into top line growth. Right next to them is going to be private equity or kind of growth round investors. They're looking for, a 3 to 5x return on that business over the next 5 to 7 years. They like real cash flow, so because they could potentially put some leverage on that, and they're likely going to want to flip that business in 5 to 7 years ish. Then you go over, and I'm sure, Chris, I'm missing some, but then you go over to strategics. Strategics is much more of a gamble, because strategics are, given the macroeconomic environment, given some subsection of the strategic strategy they're looking to do, you may fit into what they're looking to build out and expand. That could be a new product. That could be a product that is growing traction. And so it's sometimes hard and it's sometimes lucky, right? So selling to a strategic often is more about being in the right place at the right time with the right person in that strategic who has a mandate to do X, Y, Z. It's very hard to predict that, right? It's just extraordinarily hard to predict that in 7 years, someone at XYZ, big CPG, is going to have a mandate to buy my company at this stage. But even within strategics, a deal, even within a large strategic, a deal under 100 million is fairly easy for them to do. A deal between 100 million and 250 million, somewhat easy to do. After that, and especially over $1 billion, I don't care who you are. I mean, we had to go all the way through the entire board, the C level, the highest board at Nestlé. Nestlé, again, is a massive, huge CPG. At over $1 billion, it's a different level. It needs different level of scrutinies. So those are really hard. And those, to be candid, just are equal parts luck, equal part macro environments. A lot of things have to come right for a big strategic exit to happen. Chris, did I miss any buyers on there?
No, I think you got it.
Love.
But a majority of the buyers are going to be in those first two. That last one is just going to be the few buyers.
That's super interesting to hear, because I feel like in Silicon Valley there's only one buyer, which is IPO. Ideally, I mean, obviously all of these like different big tech companies will like acquire companies, but like you don't hear about family offices buying a B2B SaaS software unless it's like adjacent to whatever they're doing. Okay, so last 1 minute fire round for you guys. What's your favorite book?
Ooh, favorite. I'd say The Second Mountain by David Brooks is a good kind of mid-career read. If you haven't read it.
Love that. I'll check it out.
My favorite, I think, hard is The Sun Also Rises by Ernest Hemingway. It's an old classic.
Wow. Who would you invite to your dinner party?
Dinner party. Ooh.
I would invite my wife, because she is by far the best guest. And then I get some brownie points for saying that.
I was going to say, you just have a big party with friends, family. My wife and I always joke we want to have our wedding again because we were kind of caught up in everything, and we just want to have a big party with everybody.
Love. Who made the biggest impact in your career?
Oh, should we say the same person? Probably. No, I don't. I mean, for me, I'd say it's Bob Davis. I would say so far he was my Chris's old boss at Highland. He was my first investor at Freshly. It really honed me to be the CEO I am today.
Wow.
Yeah, no, Bob was a great mentor, I think, for both of us. Another one in similar vein is Peter Bell, one of the other partners at Highland, who I was fortunate to take a course with him at Boston College. He taught back in 2008. So when I was 19, 20 years old, gave me a glimpse into entrepreneurship, venture capital, and kind of set me on a course and a career in those sectors. So shout out to Peter.
Wow. I mean, like, we rarely hear they just shout out to like all the investors. Love that. Where can we find you outside of work?
Might be the same answer for both of us, but we both have young kids. I've got a 3-year-old, a 5-year-old, so it's typically with them and my wife outside of work.
That's going to be it, and occasionally golfing. So when I have time.
Love that. Well, Mike, Chris, thank you guys so much for coming on the show. It was such a fun conversation. It's like so interesting to hear from both like entrepreneurship and investor perspective. You rarely get to see them both at the same episode, basically.
We very much appreciate it, Grace. Thank you.
Let me quickly end stream.